In this video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. So most of my videos are recorded and scheduled the day before and uploaded for the next day. For 5 days out of 7, it's a trading day, so of course by the time the video goes live on my channel, the price would have already evolved from there. If there are significant and very volatile movements during the trading day, obviously they will not appear in the video on that day. But usually, to the extent possible, my analysis will be based on the medium term and not really focused on the intraday movements. The reason why it shouldn't matter that much either way is because most people investing in stocks invest for some kind of reason that takes time to get developed, and that their positions are usually kept for at least a few weeks. With that being said, if there are significant stock price movements that happen afterwards, either they will not affect the overall picture, or if they're significant enough, they will be mentioned in the next video about the stock, with reevaluations of the circumstances as needed. Sofi Technologies operates in financial services. It provides services of loan, refinancing, and credit cards, as well as wealth management solutions. It is a company based online and separates itself from conventional banks mainly from the difference between physical and virtual operational environments. Its appeal is the massive user base subscribed to its platforms, consisting of a large pool of potential clients, contributing to the fast growth of its revenue amount and in the number of revenue streams. Sofi benefits from the presence of famous investors, almost perceived as superstars in this day and age, and the fact that after years of discussions and speculations about what we would like to call a lightweight bank, because it is now mature enough to get deployed to consumers at large. The market cap of Sofi Technologies is currently at $12.1 billion, and the enterprise value is at $15.2 billion. The market cap is the price tag financial market wants to evaluate the company at, considering its future potentials and short-term fundamentals. The enterprise value, or EV, is the net result of the company's assets once all the debts are paid back. Usually the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged or the company may be under a lot of selling pressure from the market. The quick ratio of Sofi Technologies is 18.3. The current ratio is 18.3 as well, and the debt over equity is 0.66. The average trading volume of Sofi Technologies has been 38.06 million shares, and the daily volumes recently have been 40.2 million shares, 32.4 million shares, and 25.26 million shares. The 1-year beta of Sofi Technologies is 0.89. Its 52-week high is $28.28, and a 52-week low is $10.81. Let's also look at the options market for Sofi. In terms of volume and open interest, the options market is favoring the call side. Generally speaking, the put options mean that the market expects a pullback, and the calls options mean that the market expects a move up. The key strike prices where there seems to be the most interest are $15, $16, and $17. Sofi has had a fairly rough week, with its recent momentum fading away and the general market condition now favoring safer, more time-proven investments than growth stocks. The good news is that Sofi is now relocated on a support line. Sofi is now located on a support line that has been tested several times before. It's interesting to notice that new peaks have been lower since a while now. It's possible that someone is trying to unload their positions because they think that the short-term price of Sofi may not go beyond $25. Then buying Sofi would be a very smart move. But at the same time, we have to be aware that the fintech industry has been around for a fairly long time now, and may be getting more crowded as well. This is why we do have to be careful when buying the individual stock. Perhaps it is wiser to build a basket of fintech stocks with Sofi in it as well. Ultimately, I think that if our analysis is accurate, Sofi should be able to take off in the years to come. I would recommend to buy up to 1% of your portfolio, with 50% of your allocation bought in now, because I think that the short-term corrections may be touching its end. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.